Now, I have to be honest, for all of my years invested in markets through cutting cycles and hiking cycles with the Fed, good economic times and bad economic times, this is probably the most confusing period in markets that I've ever witnessed. Confusing in the sense of some people think the markets are going to rally after the Fed, like Tom Lee, like I'll show you here in this video. And then a lot of people think there's going to be this sell the news event coming next week when the Fed cuts rates. I mean, hell, markets are split basically 50-50 between whether we're going to get a 25 basis point cut or a 50 basis point cut. But let me tell you right now, we already know what we're going to get. I'll tell you about it here in this video. And here in this video, I will share with you what is most likely going to happen in markets. And if that most likely scenario, in my view, does not happen, how you need to position in markets for that other side. And if you're a little bit confused, I don't blame you. Again, this is probably the most confusing time I have ever seen in markets, and hopefully this video provides you that context and insight you need to know. So first and foremost, I want to kind of explain if we're going to get 25 basis points or 50 basis points. And even when you're looking at this, people are split. I did a poll on X. 48.7% of you guys said 25 basis points. 35.9% of you guys said 50 basis points. And 15.4% of you guys said we're fucked either way. But let's not kid ourselves. Ever since 2002, Nick Timmerhouse has always leaked the markets something to prepare us for Fed policy, because the Fed has this thing called a blackout period that is about 10 days or so where you don't hear anything from Fed officials. You don't get any interviews, you don't get any, CNBC visits, you don't get anything. And sometimes we get big economic data that can sway the Fed's opinion within that 10 days or so before the Fed meeting. Like this past week, we got CPI data, we got PPI data, and then Nick Timmerhouse came out with a, opinion piece, if you will, debating whether the Fed should do 25 or 50 basis points. But then the last line of that article basically confirmed the Fed's going to do 50 basis points. So what happened was on Thursday, markets were pricing in a 14% chance of a 50 basis point cut. So basically there was no chance of a 50 basis point cut. That article came out from Nick Timmerhouse last night, Thursday night, into Friday. Markets priced in about a 52% chance of a 50 basis point cut. So we still need another article from Nick Timmerhouse. We still need retail sales to come in a little on the light side to push markets higher with that probability of 50 basis points. So technically it's still on the table, if you will. It's still close to 50-50. But we already kind of know the Fed's going to do 50 basis points at this point. If the Fed only does 25 basis points, then Nicky Leaks can just get thrown out the window. Nick Timmerhouse doesn't know shit. Okay, now that that's established, the Fed is going to do 50 basis points, more than likely. Now that that's established, the Fed's going to do 50 basis points. What does this mean for markets? Well, on one hand, you have a Fed that is reacting to the economic data that is likely trying to prevent further weakening in the labor market. That's actually doing what they are talking about. The Fed said last press conference, last FOMC meeting, they don't want any more weakening. And now they're going to do a 50 basis point cut. That puts talk to paper. That is something I could see the markets liking. A 50 basis point cut versus a 25 basis point cut likely drops the odds of a recessionary environment. Now the question is that enough? Is there too much pain already done? Only time will tell over the next couple of months. The flip side to that is 50 basis points may say to the markets, the Fed is behind the curve, they're late, and there's probably going to be more pain out there. Because historically, since 1995 at least, in recent history, the Fed started their rate cutting cycle in 2001 and 2007 with 50 basis point cuts both times. And over the next 1, 2, 3, and 4 years later, markets were in the red. 2 years later, in 2001, markets were down almost 31%. And 2 years later, in 2007, markets were down 26.3%. So there's not a good precedence around 50 basis points. Whereas in 2019, 2 years later, after the Fed cut 25 basis points at the first meeting, their first cut being 25 basis points, the S&P was up 54.1% 2 years later. In 1998, the S&P was up almost 41% 2 years later. And in 1995, the S&P was up 73% 2 years later. So if the Fed starts with 25 basis points, that tends to be a better market over the next coming years. Now, the other thing I think we need to ask ourselves is, have the markets already priced in a 50 basis point cut, and what kind of effects that would have on stocks? Imagine it like this. It's kind of like Nvidia that rallies into its earnings report like it did last quarter. And then you get a really good earnings report, but it was priced in, so the stock fell anyways. And this is Nvidia's chart. Nvidia fell 2% the day of earnings, 6.5% the day after, and then subsequently fell even further because it rallied a lot heading into it. Same kind of thing could be true for markets today. You fell 4% in September, 4.5% or so. You've rallied back everything. You're back to almost new all-time highs. So could the markets have already priced in Fed easing? We'll talk about that a little bit more here in a couple of minutes on where you could position in your portfolio if markets actually do move higher. But first, I think we should acknowledge the last time the Fed cut rates without a full-on bailout panic, okay? COVID, Rona, the Fed cut rates basically to zero overnight, okay? That's not what I want to focus on here, because this is not a COVID event that we're heading into next week. Perhaps it could be. It's going to take some time for that to develop. And I'm not in that camp. I don't think the Fed's going to have to cut to zero all at once because there's some big shock that happens. Hopefully you're not in that camp as well. If you are, let me know what you're seeing, because I'm not seeing anything that would suggest that. But back in 2019, on August 1st, the economy started to weaken. It had started to weaken a couple of months before August, okay? The Fed decided to lower rates on August 1st. And then what happened? This was a dovish cut from the Fed, a 25 basis point dovish cut. Markets were up, as I showed, 46.5%? Or 54%, 54% higher 2 years later. Markets were up 13% 1 year later after 2019. But what happened? The S&P fell almost 7% following the first cut in 2019. About 6.83% over the course of about 4 trading days. It was a pretty aggressive downside correction. And then you had some chop, you had some volatility, and markets realized, oh yeah, we're probably not going into a recession. And then you had the end of 2019 rally, which was very aggressive to the upside. And from the August 5th lows, coincidentally August 5th, 2019, the S&P was up almost 22% by March of 2020. And then the rest is history. So even the last Fed cut you had that was not in a panic in 2019, August 1st, it was still a sell the news event. And that was even a 25 basis point cut. And I would argue if we do a 50 basis point cut, you're going to see a sell the news event. I would be very surprised if we did not see any kind of sell the news event. Unless, of course, let's say Monday and Tuesday are just really bad days, like 2-3% down days apiece, then you probably get a rally on the first Fed cut. But if markets just stay where they are, kind of trade sideways, heading into next Wednesday, the Fed meeting, you're probably going to see a sell the news event, and markets are probably going to sell off. Now, I would even argue that the economy today looks dicier than it did in 2019, for a lack of a better word. Yes, there was some slowing around the hinges in 2019, but today's economic data looks much worse than what you've seen in 2019. Now, this Wednesday's a little bit interesting as well, because we do have the election coming up in just a couple of weeks. Markets really haven't priced that in. We haven't priced in what the tariff policies could do or higher corporate tax rates. And perhaps after this Fed cut, the next big catalyst markets are going to be looking forward to is the election. And it could make sense why you start to price in the election around the same time that you get the first Fed cut next week. And I could see how the two intertwined could cause some downside. Now, the other aspect of this upcoming Wednesday's FOMC meeting is we get a new dot plot. So this is the last dot plot we had. It's basically just a summed up summary of what Fed officials are expecting for GDP, unemployment, PCE, and the federal funds rate by the end of these years. So you have 2024, 2025, and 2026, as well as the longer run. This is seen like neutral, just a normal year economy for the US, okay? The biggest thing that matters, the only thing that really matters right now is 2025. Now, longer run, that can move. It's not something markets normally react to. Last dot plot we had, they actually brought up the expected neutral rate or longer term federal funds rate from 2.6% to 2.8%. Markets didn't even react to that. We didn't care about that. So I don't think the longer run category matters. 2025 matters a lot. The two things that matter the most is GDP projections. The last dot plot, the Fed kept their estimate at 2%. If the Fed moves their estimate down, let's say to 1.5%, that's not too bad. If they move their estimate to 1% or lower, then yeah, the Fed's forecasting quite a bit of weakening here in the economy. The unemployment rate is currently at 4.22%. It was at 4.26%. It ticked downwards to 4.22% in the last report we just got. Well, the Fed's expected end of the year 2025 unemployment rate is 4.2% as of the last dot plot. Do they raise that to 4.5%? Okay, that's expected. If they raise it higher than 4.5%, that's likely a negative catalyst for markets. Now, the other thing that matters is the projected federal funds rate. So back in March, the Fed was pricing in 3.9% by the end of 2025. Markets are currently pricing in around 8 rate cuts by the end of 2025. So we can actually take a look here at the July 16th, 2025 Fed Funds Futures contract. The highest likelihood of 31%, that is the federal funds rate will be between 2.75 to 3%. We're pricing in more cuts after this. So the Fed's actually expected to cut rates basically every single Fed meeting over the next 12 months. Now, the question is, does the dot plot actually show that, right? Does the Fed take their dots down to 2.7%? That's roughly where we're going to be expecting the federal funds rate in a year from now. Well, technically, we're pricing in a federal funds rate of about 3% by the end of 2025, but give or take one cut, 3.25%, 3.75%. It's not going to matter. That's basically going to be in line with markets' expectations. If we get less cuts than that, if the Fed's projecting like 3.5% for the federal funds rate, that could actually be seen, weirdly enough, as positive, because if the Fed's not expecting to cut as much as the markets are, then maybe the Fed is seeing a stronger economy than we are. So long story short, I think there's a lot of implications that could make a 25 basis point cut or 50 basis point cut, either bullish or bearish coming Wednesday. The biggest things that matter is the GDP expectations, the unemployment rate. Now, you can add in there the federal funds rate projection, but that changes on every single data point we get. So I don't think that's going to hold too much weight from the markets. As long as it's not like super out of the range that we're expecting, which I don't really think it's going to be. I think the Fed's probably going to price or tell us what the markets are pricing in. And that's one of the aspects that makes this Wednesday so confusing is we just don't know what the dot plot's going to look like. And I'll just tell you right up front, I think there's probably a 70% chance the markets sell the first Fed cut. Typically, the best sweet spot period to be in at the end of a hiking or tightening cycle is after the last cut before the first cut. So the Fed hiked rates in July of 2023. Ever since then, you've been in the sweet spot for markets where the economy's holding up, the Fed has raised rates, they're not raising rates anymore, markets are looking ahead to the first round of cuts. Now we're getting to the first cut. The question now is the economy holding up? Are we going into a recession? And I think until we get that question answered, we probably have limited upside. That's number one, at least in the broader S&P. And we also probably have limited downside as well. I think at best, a 10% correction is probably all we're going to get, unless we get some kind of big surprise or shocker that I do think is a low odds. Now, whether or not we end up falling 20, 30, 40, 50% from here depends if the economy weakens, if we head into a recession. But I don't think that's going to be, this upcoming Wednesday's downfall moment for markets. I just don't foresee that. But can it cause a correction? Mix that with election risk? Of course. And again, that's even what happened in August 1st of 2019, is you had a 7% correction within 4 trading days after the Fed cut rates, with a pretty similar economy to what we have now, with which I would say today's economy is a little bit more dicey, a little bit more on the fringes of a broader slowdown than even what you had in August of 2019. Now, I will say, if I'm wrong, if there's what I think a 30% chance markets take the 50 basis point cut as, the Fed's lowering odds of a recession, the Fed's going to react, the Fed put is back, we want to go all in markets, we want to go crazy and buy stocks. That's possible. Markets could do that. And you want to know what's crazy about that? Is we kind of seen the first taste of that on Friday. I think the areas that did well on Friday are going to be the same areas that do well if we get a bullish Fed meeting on Wednesday. That is going to be the Russell 2000 that went up 2.5% versus the S&P that was up 0.5%. That is a 5x outperformance. That area is going to do well. I think the Dow is going to do well. I think cyclicals, industrials, value, high-paying dividend, quality companies are going to do very well. I think software stocks, heavy growth stocks are going to do exceptionally well. And I've actually talked about this for a while now here on the channel. I've said basically, I don't want to be in big tech. Either which way this thing goes, I've said this for weeks now, I don't want to be in big tech. Whether we get a rally in markets or whether we get a fall in markets. I just don't want to be in big tech. There's not enough upside potential. There's too much good news priced in. And if, markets do rally after the Fed starts to cut rates, big tech's not going to participate. What'd you see on Friday? Apple was red. Meta was red. Amazon was red. Nvidia was red. Google and Microsoft were positive. Google did the best, up 1.82%. Microsoft only up 0.84%. All of these stocks declined further in after hours. Do I really want to own that area of our markets? Absolutely not. And really, I think any area of our markets is better than big tech. I'm just going to be honest with you. So that's the area I'm positioned in my portfolio that is not in cash, okay? And the areas that I'm looking to buy are small caps, high dividend paying values, cyclicals, right? These areas that will do very well when the Fed cuts rates, and basically the areas that did well on Friday. Like if you're totally lost on what's going to do well, if we do have a bullish first cut from the Fed, if stocks take off, just look at what did well on Friday. Look at single stocks that did well. Look at the Russell. That's what is going to massively outperform big tech, massively outperform the broader S&P. Because I still have to be honest with you, the S&P is pretty much priced for perfection still at this point. And yes, we're still going to have a risk of a recession. We're still going to have a risk of a slowing economy that's going to hold the markets in a tame level, right? We're not just going to break out and just go crazy high. with all of the risks that we have that are not going away for many months at least. But high paying dividend stocks, value stocks, cyclicals, interest rate sensitive stocks, those guys are bargain bin for a lot of those sectors and companies in them. So that is going to go ahead and conclude this video. That is what you guys need to know. Let me know what you think about this down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a great weekend, and I will see you in the next one.